Hey, what's going on, Profit Bulls? What are large cap stocks, you might ask? I'm your host, Dom. Hear me out on this. I'm going to explain what exactly large cap stocks are. Large cap stocks, also known as big caps, are shares that trade for corporations with a market capitalization of $10 billion or more. Large cap stocks tends to be less volatile during rough markets as investors fly to quality and stability and become more risk adverse. These companies comprise over 90% of America's equities marketplaces, and including names such as mobile communication giant Apple, multinational conglomerate Berkshire Hathaway, and oil and gas colossals ExxonMobil. Many indices and benchmarks follow large cap companies such as the Dow Jones Industrial Average and the Standard & Poor's 500, known as the S&P 500. Since large cap stocks represent the majority of the US equity market, they are often overlooked to a core portfolio investment. Characteristics often associated with large cap stocks include the following. Transparent. Large cap companies are typically transparent, making it easy for investors to find and analyze public information about them. Dividend payers. Large cap, stable, established companies are often the companies investors choose for dividend income distributions. Their mature market establishment has allowed them to establish and commute to high dividend payout ratios. Stable and impactful. Large cap stocks are typically blue chip companies at peak business cycle phases, generating established and stable revenue and earnings. They tend to move with the market economy because of their size. They are also market leaders. They produce innovative solutions, often with global markets. Operations and market news about these companies is typically impactful to the board of markets overall. Key differences. There is a decided advantage for large cap and in terms of liquidity and research coverage. Large cap offerings have a strong following, and there is an abundance of company financials, independent research, and market data available for investors to review. Additionally, large cap tends to operate with more market efficiency, trading at a price that reflects the underlying company. Also, they trade at higher volumes than their smaller cousins. Small cap stocks tend to be more volatile and riskier investments. Small cap firms generally have less access to capital and overall not as many financial resources. This makes it difficult for small companies to obtain the necessary financing to bridge gaps in cash flow, fund new market growth pursuits, or undertake large capital expenditures. This problem can become more severe for small cap companies during low in the economic cycle. Despite the additional risk of small cap stocks, there are good arguments for investing in them. One advantage is that it is easier for small companies to generate proportionately large growth rates. Sales of 500,000 can be doubled at a lot more easily than sales of a $5 million. Also, since a small, intimate, marginal staff often runs smaller companies, they can more quickly adapt to changing market conditions. In somewhat the same way, it is easier for a small boat to change course than it is for a large ocean liner. Likewise, large cap stocks are not always ideal. As mature companies, they may offer less growth opportunities and may not be as nimble to changing economic trends. Indeed, several large companies have experienced turmoil and have lost favor. Just because it's a large cap doesn't mean it's always a great investment. You still have to do your research, which means looking at other smaller companies which can provide you with a great bias for your investment portfolio. Let me know in the comments below what you think of the large cap stocks and the small cap stocks. Which one you would prefer to invest in, and what you would see your overall growth potential with diversity of portfolios.